Hi, welcome to Slay the Spider. I'm Jim B, and I'm the creator and host of Slay the Spider. Shares of the S&P 500 are called S&P Depository Receipts, SPDRs. Spiders. Slay the Spider means I intend to beat the S&P 500 quite substantially. There are three major influences on the movement of stock price, according to a study by Benny King. 80% of your investment success will be due to the movement of the sector and the market. Now you can view a weekly snapshot image of the market and the sectors. This is a snapshot from April 9th, 2021. The red arrow, pointing towards the 2 o'clock position, represents the market. The rectangles each represent a mini-sector. They are color-coded to the sector they represent. Healthcare mini-sectors are in red, technology is dark blue, financials are green, media communications are brown, industrials are purple, consumer discretionary are light blue, and all the others are gray. I've been charting this movement since 1998 over more than 25 cycles using this exact mix of 40 mini-sectors. The key to understanding the movement and what makes the cycle predictable are the psychological stages that investors experience as they go through complete market cycles. It rarely changes. These stages are on the outside border of the circle. The placement of the sectors and the market are completely data-driven. The interpretation of what to expect next is from my experience of going through the cycle dozens of times. I'm not always perfect, but the beauty of the circle is that it corrects me quickly when I don't get my prediction absolutely correct. I've learned it's okay to be wrong now and then, but absolutely abysmal to stay wrong when the data says otherwise. The movement in the sectors were interesting this week. First, in the healthcare sector, biomedical advanced, healthcare was unchanged, and drug stocks advanced. In media communications, internet stocks advanced, telephones declined, and media declined. In technology, software advanced, semiconductors declined, computers declined, and electronics declined. Consumer discretionary stocks were mixed. Retail declined, restaurants declined, household products declined, autos advanced, leisure advanced, and gaming stocks advanced. In financials, Wall Street stocks declined, real estate declined, banks were down, savings and loans were unchanged, finance declined, and insurance declined. In the industrials, waste rose, metals declined, building products declined, machinery and tools were unchanged, steel declined, chemicals declined, and aero defense declined. In the others group, textiles declined, forest products declined, transports declined, precious metals declined, electric utilities declined, oil services declined, food declined, business products were unchanged, oil declined, gas utilities declined and crossed to the bear side, protection and safety also declined and crossed to the bear side. This week, four mini sectors remained unchanged, 8 sectors rose, and 28 mini sectors declined. 2 sectors crossed from the bull side to the bear side. We now have 8 sectors on the bull side and 32 on the bear side. Overall, the market score declined from 48 to 36 on Tuesday and rebounded back to 42 on Friday. For the week ending July 23rd, all three major indices set new highs. The Dow was up 373 points, or just over 1%. The S&P was up 84 points, nearly 2%. NASDAQ was up 409, up 2.84%. 152 more stocks moved from buy signals to sell signals this week. The overall market score was 48 a week ago, dipped to 36 on Tuesday, and recovered to close the week at 42. Isn't it amazing what $579 billion in deposits from stimulus checks and 20 million new investors since the pandemic started can create in terms of a bubble? Reminds me of 1999's dot-com bubble, but this one was larger in scale. The Slay the Spider video is worth watching each week because between 2 and 4 times each year, it's also important to your financial health and well-being. The consolidation of the sectors over the past 2 weeks, and especially this past week, indicates something big and very negative is about to happen in the markets. The 4 o'clock loop is clearly forming up. Investors are actually taking actions to protect themselves, and it not only shows up on my charts this week, but also if you look at interest rates, both short-term and longer term, investors are taking defensive positions. The 4 o'clock loop is the second most damaging stage of the 16 stages I detailed in my April 16th video.